to navigate your wealth. My name is Cynthia DeFasio, joined today by Stawicki and Samantha Irish of Compass Financial. And to our viewers at home, we have a very jam-packed show for you today. We're going to talk about how your taxes are up for election every 2 years. What? Wait, every 2 years? Just wait. We're going to talk about that today. Karen, how are you?
I am great. You look fabulous in red, by the way.
Thank you. It's such a happy color, and you look beautiful in the taupe beige. Absolutely. Samantha, how are you?
I'm good. I'm so glad that you're here, and I cannot wait to share our messages today. We're really excited.
I'm excited, too, although I'm not really excited about talking about taxes. But
come on, we'll make it fun, we promise.
You always make everything fun. But let's talk about, why are your taxes up for election every 2 years?
Well, before we get up to talking why they're up for election, we really need to talk about that subject of taxes. You know, when people talk about financial planning and you come in and you meet with a financial advisor, you're thinking you should be talking about whether you should be in the stock market or bonds or buy gold or buy real estate. And while all of that is very important, if your financial advisor is not talking to you about the tax risk that every one of your dollars is exposed to, you are talking to the wrong advisor, I promise you. You know, the problem with taxes is that they go up, they go down. I started in this business in 1980. The top marginal bracket was 70%. If you were a married couple earning $100,000 a year, you were in the 59% bracket. So when we told people to put money in the 401k, it was good advice.
Right.
We said you're going to be in a lower tax bracket when you retire. Well, roll the clock forward today, most of my clients are still complaining that they're paying taxes, but they're paying at 25, 30, or a top 35%. The problem today is that we are actually in the lowest tax base in history, and I don't know about you, but I'm pretty sure our national debt is at a really high number, and Congress doesn't know how to stop spending money.
True.
And so the only solution eventually is probably going to be raising taxes. But you know, raising tax brackets isn't the only way your taxes go up.
There's actually 6 ways that your taxes can be affected, and this is why we say they're up for election every 2 years. So the first way that you can have more taxes that you owe is if you make more money. Now, that's a good thing to make more money, but sometimes it feels bad when you make more and you have to give more back.
True, very true.
The next way is if they raise taxes. And I think this is the way that most people, when they think about taxes going up or having to pay more in tax, it's just by taxes being raised. The third way is if they change and adjust the tax deductions, right? Your mortgages, different things over the years, your Sears card, used to be deductible, now they're not. So deductions affect how much ultimately you give to the IRS.
True, okay.
The fourth way is expanding taxes. And the best example for expanding taxes is Social Security. Think about it. Social Security used to be 100% tax-free.
It's true.
Now, if you make over a certain amount, which is a marginal amount, 85% of your Social Security is taxable.
Wow.
So those are another way that it used to be not, but now it is.
There's 2 more ways.
There's 2 more. The fifth way is legislative change. Thinking about RMDs, the Secure Act, forcing you to take money from those tax-advantaged accounts, and now all of a sudden that money is taxable. And the last way is the saddest way, unfortunately, but we like to call it the widower's penalty. If you're married, filing jointly, and all of a sudden your spouse passes away, now you're filing as a single. And if you look at the exact same income bracket that you were in, but now as a single filer, chances are that bracket is actually higher.
Wow.
So it ultimately is hurting you to now be a single filer.
Which is so sad when you think about it, because you're going through the loss of a spouse, and then you also have to incur an additional tax burden.
Add insult to injury, absolutely.
Yes.
You know, when we talk with clients, and I know many advisors try to talk about taxes, they say they want to dodge the bullet. And what we say is, wouldn't it be better to keep you out of the line of fire? Keep you out of the line of fire. If we can find a way so that your assets are not affected every 2 years when they elect new individuals and they try and change things.
Yes.
And we'll talk more about how to do that in the show.
Yes, absolutely, because it's such an important piece of the holistic retirement plan or puzzle, tax planning, but so often people neglect to think about tax planning, correct, Sam?
It's For us, it is definitely one of the top 3 things that we are making sure that you are focused on. And we actually have a way for you to be able to find out how much tax you might be paying on your retirement accounts. If you go to our website, you can create your own tax burden. It's www.navigateyourtaxes.com. And there you'll be able to put in the numbers and understand how much tax am I ultimately going to pay. Here's the thing, when we talk about taxes, it's not about 1 year. It's about what you pay over your lifetime. And our goal is to make sure that your lifetime tax is as low as legally possible. We want to make sure that you get to keep that hard-earned money, that you're not giving it away to the IRS. Mom has a saying about it being optional tax, and when we come back from the break, we're going to discuss what that means and how you can keep more of that money. You worked really hard for it. You deserve to keep it.
Absolutely. And Samantha, you have a very special message to our viewers at home before we take our first commercial break.
We want to make sure that you know exactly how much money you have to spend in retirement. Remember, it's not about how much you get to have, it's how much you get to keep. So we want to make sure you're keeping as much money as possible. Pick up the phone now and schedule your complimentary review. You can call the number on the screen, 855-348-3073, or you can scan that QR code. We want to make sure that you have the confidence to know you're not giving the government any more than they actually need.
Samantha, thank you so much. Karen, thank you so much. To our viewers at home, that number to call is on your screen, 855-348-3073. As Samantha and Karen have mentioned, you've worked your entire life to get to the retirement years. You deserve to have tax planning as part of your as part of your retirement savings, as part of your retirement journey, I should say. That number to call once again is 855-348-3073 to schedule your complimentary consultation, or you can pick up your smartphone, click on the QR code, schedule your time accordingly with Compass Financial. We're going to take a very short commercial break. Don't go anywhere. When we come back, we're going to talk all about tax planning and how this will benefit your overall retirement plan. Stay tuned.
So my career path to actually becoming a financial advisor was a little wavy. It was not a direct line. I said at 11 that I was going to join my mom. You know, when I went to college, I was like, okay, Mom, I'm gonna go be a finance major. And she said, don't go learn finance. I can teach you finance. Go learn something that's helpful to our business and for our future clients. So I was a communications and sociology double major, which means that I focused on what people were saying and what motivated them to take action. And so when it comes to sitting down in a meeting with our clients, Mom and I are constantly going back and forth between educating and listening. But my job really is to say, what is the client not saying? And what's the question that might be forming in their brain? I really bring in a non-financial background to really meet them where they're most comfortable. I bring in that personal connection, and I want to understand what is their motivation for retirement. You worked through your working years so that when you got to retirement, you got to live your dreams. Is your dream to be a world traveler? Is your dream to give back to the community and be charitable? What do we need to do in our planning to make sure that that dream is a reality?
Welcome back to Navigate Your Wealth. My name is Cynthia DeFasio, joined today by Karen Stawicki and Samantha Irish of Compass Financial, and we're talking all about the importance of proper tax planning for your retirement years. Samantha, let's talk a little bit more in depth about some of these ways to mitigate the tax burden, if you will. There's so much I want to say, I got to get it out there.
It's okay. I know the feeling. You know, it's such an interesting thing because when clients come to us, I think a lot of times they believe that they're being tax focused or that they're not ignoring taxes, right? Most CPAs are working with their clients, who also become our clients, to help reduce their taxes. The problem is that reduction is an immediate gratification, right? They're thinking about the ways that they can make a contribution to their 401k or contribute to an IRA to reduce their income today.
Yeah.
Unfortunately, by focusing on today and only today and not thinking about the future, they're actually making the situation worse. So for us, we always have the conversation, is it better to pay on the seed or to pay on the harvest? And truly, we believe that it's both. And each individual situation, which is why we customize our suggestions and our recommendations to our clients, because we want to make sure that it fits you and your needs. But the thing is that there are so many proactive tax favorable ways that think about the longevity and not just today.
Okay.
So some of the things that we like to focus on is Roth IRAs and cash value life insurance.
Okay.
So Roth IRAs have so many benefits for the long term.
Okay.
The problem is that with a Roth IRA, there's some limitations that are around it. Right now, there's the contribution amount. There's also the age limitations around it, and you have to be working. We like to say that the cash value life insurance is like a Roth IRA on steroids because there's so much more flexibility to it. You still have the same tax advantages, but you also have a lot more control over the asset.
Okay.
And control to those dollars. And so when we talk about having control to those dollars, it gives us an opportunity to share client stories, which I know Mom has one that she's dying to share, about how our clients are able to save a bunch of money and be able to have access to those tax-efficient dollars.
Amazing. Well, let's talk about that client story, Karen, please.
Right, absolutely. Well, this client came to us from our TV show, and she had been doing a wonderful job of saving, and she knew she was doing a good job of saving. She made a lot of money. She made $800,000 a year, and she had a couple $1 million in her 401k and said, I can give you $200,000 a year for the next 4 years. What can you do? Well, I thought, what could I do? You've given me some good assets to work with. But we really sat down and looked at what she had. And she did not understand a couple of things. Obviously, with the power of 3, job descriptions of money. So we went through that. When we showed her how to create the guaranteed income she needed, but then secondly, focused on the tax mitigation, that $2 million that was in her 401k was completely taxable. And, you know, when you're putting it in there and you're getting the deduction and you're seeing it grow and you're not having to file any reporting on it as it grows, you think it's all yours.
Of course.
But it's not. And in the one section that we looked at, she had $1.6 million. And I'm sorry, $1.4 million. That's right, $1.4 million. And we did the tax burden analysis, which if you want to know if you have assets in an IRA or a 401k, and you want to know if you can see what your number looks like, I think they're going to put the code on the screen. It's www.navigateyourtaxes.com. You click on that QR code, you're going to be able to go right to the site and run these numbers. But we ran these numbers for this client, and her $1.4 million IRA, she had 2 choices. She could either kick the can down the road, which is the government's plan for her, and she would pay $1.6 million in taxes over her lifetime.
Oh my gosh.
I know, it's mind-blowing.
Wow.
That's, yeah. Or through doing strategic Roth conversions, she could pay $500,000 in tax.
No brainer, right?
But here's the thing. $500,000 is still a very big number.
It is.
And in her case, we were going to do it over 5 years. So she's going to write a $100,000 check to the IRS 5 times. That is painful, I understand. But when she realized that 1.6 versus 500,000 was $1.1 million less, the choice was obvious.
Absolutely.
And I will tell you, when you run that tax burden analysis and you see the big number and compare it to the smaller number, the difference is optional tax.
Wow, that
It's
is
optional
incredible.
tax because you opted to take that plan. Now, here's the best part of this whole story.
This is amazing.
This client, when she retires, because of the way that we set up the next conversion of the last bit of the 401k that she'll accumulate, which she's now contributing to the Roth side for her money.
Okay.
Okay. 100% of her income when she retires is going to be tax-free. That also means that her Social Security will be tax-free because she will have taxable income of 0.
That's incredible.
100%
Yeah.
tax-free. She was thrilled. And she referred us to 6 more people.
I'm sure she did. That is amazing.
Yeah.
Look at the way that you are both changing lives. I mean, it's amazing. All of the stories that you share, people just by picking up the phone and calling in have scheduled time with you, and you're really getting to know them one-on-one, their personal stories, their information, and you map out a plan, all with the power of 3.
You know, we wrote this book because we wanted to make sure that people understood that they had options.
Yes.
It's so sad to me, and I don't think that advisors are keeping this a secret because they want to penalize you or hurt you. I just think that that's not where their focus lies. And the accumulation stage of your assets and the distribution stage of your assets are so vastly different. But when we look at the distribution, that's your retirement. That's what you worked so hard for.
Yes.
So we want to make sure that you have the most spendable income in those years, not whatever the government leaves you. Right?
Absolutely.
You know, when we give her the option between having $1.6 million in taxes, the reason that she has $1.6 million in taxes is because she chose the government's way.
Yeah.
And let me explain what the government's way is, because a lot of you at home might actually be doing the government's way. It's you don't need the assets every single day. So I'm going to defer them until I have to take them for my required minimum distributions. So you defer the money. Well, every year you defer the money, it grows, fingers crossed. Well, if the money in your IRA is growing, it's not just growing for you, it's also growing for the IRS.
That account is a joint account with the IRS.
Yes.
It really is. And people don't understand that.
An IOU
An
to the
IOU,
IRS
that's
is what
right.
it is.
Which means that the amount of tax is growing.
Yes.
And so that number is deferred. Then you take the money out, and as you're taking it out, you're only taking the RMD, so you're only taking a little bit out of the account.
Right.
So it's still growing to keep growing the tax.
Wow.
And then if you pass away and there's assets that are left in it, when it gets distributed to your heirs, it's still taxable.
That's right.
So now what would hopefully be a wonderful gift to your family gets to be a little less of a wonderful gift to your family.
Yeah.
That's the government strategy. I'm not a huge fan of the government's plan most of the time. And when do they ever do things for our advantage and not theirs? The RMD strategy is actually designed for them.
Well, I'm so glad that you brought up about passing down to your heirs, because obviously, Karen, without proper tax planning, you're talking about a lot of people receiving funds, let's say from the loss of a parent. They could be in their high-end working years.
Exactly.
And so wouldn't that potentially bump them into another tax bracket?
Well, absolutely. And you know, with the Secure Act, they stretched it, or they changed the stretch for your lifetime to 10 years. But let me tell you, if you convert your 401k or your IRA into a Roth IRA, here's the ticket that you need to understand. When you pass, your children may take the money right away, but assuming that you told them not to, they actually have the ability to keep that money, based on today's current laws, in that account for 9 years. They can keep that money in there growing tax-free for 9 years, Cynthia. Now, in the 10th year, they have to pull it out, but it's 100% tax-free.
Wow.
And what an amazing gift to be able to give to your children, to say, I set this up in a Roth IRA, I've paid all the taxes, there is no more debt to the IRS that you kids have to worry about.
Wow.
This money is 100% yours. I suggest you let it grow if they still allow it, and then when you have to take it, it's still tax-free.
And now that is truly a gift.
That is truly
when
a
you
gift.
think about it.
That's right.
Well, Samantha, you and Karen have a very special offer to present. Let's talk about what that is before we reopen the phone lines.
We want to make sure that you know your lifetime tax burden. It's not about 1 year, it's about what you pay over your lifetime. Could you have $1 million that you get to keep and not give to the government?
That sounds
We
good.
want to help you
That is
find
good.
out. Go visit our website, www.navigateyourtaxes, and run your own tax burden analysis. Or better yet, pick up the phone and let's sit down and have a conversation. We want to make sure that you are given the retirement of your dreams, the retirement that you worked so hard for by keeping more of your hard-earned dollars.
Samantha, thank you so much. Karen, thank you so much. To our viewers at home, that number to call is on your screen, 855-348-3073. You've worked your entire life to get to the retirement years. You deserve to have peace of mind. You deserve to keep more of your own hard-earned money. There's a way to do so with proper tax planning for your retirement. All you have to do is take advantage by calling in today. 855-348-3073. If you don't have a pen handy, that's okay. We understand. You can grab your smartphone, click on that QR code at the bottom corner of your screen. That will take you right to the landing page for Compass Financial, and you can claim your spot accordingly. Don't you deserve it? We think you do. We'll be right back after this very short commercial break about how to keep more of your own money in retirement. Stay tuned.
When interest rates are low, you might be able to refinance your home, your car, even your credit cards. Yet when interest rates go up, it may make sense to refinance your retirement. Higher interest rates could provide income opportunities you might not be aware of. What works for your portfolio during low interest rates might not work for you when interest rates are high. Find out if a retirement refi could work for you. Call now for your complimentary Refi Your Retirement review.
Welcome back to Navigate Your Wealth. My name is Cynthia DeFasio, joined today by Karen Stawicki and Samantha Irish of Compass Financial. We're talking all about the importance of tax planning in your retirement years. I love the message of being able to keep more of your hard-earned money, Sam. Let's dive into that a little bit further.
You know, when we do the comparison with our client and she can see, you know, I have a $1.4 million IRA and I can spend 1.6 or I can spend $500,000 in taxes. That optional tax is the part that we want you to keep. That $1.1 million is what we want to give back to you because you worked hard for it. Now, in that scenario, we have another client. He had a very similar situation. He and his wife actually had accumulated multiple assets. And when, at the end of the day, we were able to show them what they could save in their taxes, it turned out that he was able to have 37% more spendable income in retirement.
37%
37% more.
Wow, that's substantial.
Think about the lifestyle that you could have if today you were just given 37% more income. You didn't have to work any harder. You just got to keep 37% more.
Who would say no?
Let me explain, though. I think people say 37% more. Where does that really come from? Let's just use a really simple example. Let's just say you wanted $100,000 for your retirement income. That's a simple number. If you want 200 or 300, just multiply by 2 or 3. So if you want $100,000 and everything is in your IRA, then when you take that $100,000 out, remember, it's not all yours. So assuming taxes are where they are right now, let's just say, make it simple, you're going to pay 25% in taxes. So you have to send the IRS $25,000, you get to keep $75,000. And you don't know any better, so you think $75,000, that's what I have to live on.
Right.
But through proper tax planning, let's say that half of the money came from the taxable side. That's $50,000. Now that's taxed at a lower bracket because 50 is in a lower bracket, so it's 15%, let's say.
Okay.
That's $7,500 in tax, $42,500 for yourself. But you don't have to just live on that because remember, tax diversification, we have $50,000 coming out of a tax-free bucket. The tax on tax-free is zero.
That's amazing.
$50,000 plus $42,500 is $92,500.
Wow.
$92,500 versus $75,000.
That is amazing.
That's 37% more income.
And all it comes down to really is proper strategizing with taxes.
That's
and
right.
so often people are not hearing this, but they're going to ask themselves, I always think what the viewers are thinking, they're thinking, why haven't I heard this before? Why hasn't my advisor brought this up?
Well, to be honest with you, most advisors are working in the world of accumulation, and they get paid for the assets that you have with them. And so if they suggest that you do Roth conversions or you diversify in ways outside of their managed dollars, they're taking fees away from themselves. I know that's a really sad statement, but it's true. And honestly, if your advisors are not having these conversations with you about how to mitigate the tax and how to tax diversify so that you could have 2 bags of money instead of 1 and have 37% more income, listen, you may not choose to work with us, but I promise you, you are working with the wrong advisor.
Absolutely. And that website again for people to put their information in, Samantha?
www.navigateyourtaxes.com. It's really simple. We wanted it to be user-friendly. You can go ahead and put in your asset that you have that is in a retirement account, and you can see the difference between choosing the government's way or choosing a proactive Roth conversion or a conversion strategy so that you can pay the least amount of tax. Remember, our whole strategy is we want it to be legal, but we want you to keep as much of your money as you possibly can. You worked all of those years. You need to have the retirement of your dreams. Think about what you could do with the extra 37%. Just go with me for 1 second. Take a minute and dream. Think about that trip that you want to go on, the one that you've always been planning, but it just wasn't the right time, or you just didn't have quite enough saved. Or think about the community event that you've always wanted to be able to raise your paddle at the charity auction and purchase because you knew that those dollars were going someplace good.
Yeah.
If you know that you have 37% more spendable income in retirement, you have permission to raise that paddle or book that plane ticket, or give back to your grandchildren early on when you can still participate and play with them.
You know, Samantha, one of the things, as you were saying all that, sounds great, but the problem is that people have their money in the qualified account, in the IRA, in the 401k, and they know that when they pull the money out to raise the paddle or to take the vacation or to spoil their grandchildren, that every dollar they pull out has to be shared with the IRS. And so the sad thing is they don't pull it out. We've had clients say, I don't want that money, it's taxable. And I say, well, you knew that at one point it was going to be taxable, right? Like this should not be a surprise to you.
Qualified to pay taxes.
But the problem is, even though they knew it, once they're faced with actually paying the taxes, it's a hard pill to swallow, which is why when we do the tax burden analysis for them, seeing the optional taxes, as I said, in this client's case, $500,000 versus 1.6, it was an easy answer. $500,000 is still a hard check to write.
It is, but it's better than.
That's right. That's right.
It truly is. It's more of your own money that you've worked so hard for.
That's right.
Yeah.
Samantha, Karen, I can't thank you enough for another amazing episode. A special message from you?
No, I was just going to say, please, we want to put that extra money in your pocket so that you can spend and you can enjoy and not give it to the IRS. Pick up the phone, give us a call. We would love to at least answer your questions and show you how you can have more money in your pocket. Thanks for watching.
Karen, thank you so much. Samantha, thank you so much. To our viewers at home, most specifically, thank you for spending time with us today on Navigate Your Wealth. Any questions you may have about proper tax planning, this is your opportunity to call in 855-348-3073. Be safe, be happy, and be blessed. We look forward to seeing you back here 1 week from today. Take care now. We'll see you soon.